You know, we talk about what is renormalization, and this is something that Jenny Yellen has talked about quite a bit. What do we consider normal interest rates? You know, 3 to 5% is the rough range, but in the press conference yesterday, she started using some new language, and she used the term neutral federal funds rate. And we find this, you know, it's a little bit of a change in language, but again, for her to continue talking about this theme of a return to normalization, a return to a neutral, she spoke about how current interest rate policy is very accommodative, and if you are higher than the neutral rate, whatever that is, she won't say what it actually is, you know, then we're going to be in a contracting situation. So generally anticipate that the neutral Fed funds rate will rise to its longer run level over the next few years. We think this is a very significant statement because what does renormalization mean? You know, there's a lot of different ways that you can think about what normal means in the interest rate market, but here's a quick bit. This is a 50-year chart of 10-year interest rates, and if you look at the average is just about 6.5%. So, I mean, we're not even close to what the average has been over the last 50 years. Now, if you chop off some of the super high rates from 1980 to 1985, the long run average is closer to, you know, 4.5 or 5%, and that's what we're continually going to say, that 3 to 5% is a normal range for the 10-year, and we think that's what the Fed is looking to get back towards. But you know, you can't ignore the fact that normal over the last 50 years has really been considered 6.5%. But why do they want to renormalize? What's the big idea of renormalization, and why is that having this risk-off effect on the market right now? The big reason is that when rates are at 0.25% and there's some kind of a catastrophe, the Fed can't do anything. They're helpless. So what we see right now is by getting rates back up to, if we get Fed funds, we're going to be in the mid 1% by the end of this year. We get Fed funds back into 2 or 3%, and then there's some sort of major, you know, terrible thing happens, whatever the next crisis is going to be, seems to happen about every 7 or 8 years. Well, now the Fed will actually have some arrows in their quiver to then lower rates to respond to a crisis. So the Fed is just inept when rates are this low because they can't respond to a crisis, and that's of course what the Fed wants to do.